Welcome back to the deep dive.
Yeah.
You're ready to get our hands dirty. Today we're diving into the world of inventory accounting.
Inventory accounting.
Inventory accounting might not sound like the most thrilling topic,
Yeah.
but trust me, there's a lot more to it than meets the eye. We're going to unpack IAS 2, the International Accounting Standard 2, and see how it shapes businesses worldwide.
It really does. You'd be surprised the ripple effect these accounting standards have on everything from a company's profit to their taxes, even their overall financial health.
All of that from how you count your inventory.
All of that.
Wow.
Yeah.
Okay, well, this is important for you, the listener, because, well, whether you're investing, running your own business, or just curious about how the financial world works, understanding IAS 2, it can give you a real edge.
Absolutely. What's fascinating is that IAS 2, it's not just about setting rules.
Right.
It's about understanding the story behind the numbers.
Okay, so let's start with the basics. What exactly is inventory? And why is it so important in the accounting world?
Well, in the simplest terms, inventory is anything a company holds with the intention of selling.
Okay.
IAS 2 actually breaks it down into 3 types. Goods ready for sale, goods that are in production, and then the raw materials and supplies that are needed to make those goods.
Okay, so let me try an example.
Okay, yeah.
If I think about a furniture store, their finished sofas and chairs ready to be sold, that's their held-for-sale inventory.
You got it.
Okay.
The in-process would be like the furniture that's partially assembled in the workshop.
Right.
And then their materials and supplies. That's all the lumber, the fabric, the hardware.
Makes perfect sense.
Yeah.
But how do we put a value on all this stuff?
Yeah.
I'm guessing it's not as simple as just totaling the receipts.
You are right. It gets a little more complex than that.
Oh, no.
So IAS 2 tells us that inventory has to be reported at either its cost or its net realizable value, whichever is lower.
Okay.
This is all about making sure that a company's assets are shown realistically and transparently.
Okay, net realizable value.
Yeah.
Now that rings a bell. Isn't that basically what a company could realistically sell an item for minus any extra costs like marketing or shipping?
You nailed it. So let's say a tech company, right, has a warehouse
Okay.
full of last year's tablet model.
Okay, yeah.
Now, even if they paid a certain price for those tablets, their net realizable value is probably way lower now because a newer model is out,
Right, yeah.
you see.
Totally. So a company might have to accept that their inventory is worth less than they originally thought.
Yeah.
Does that mean they'd have to adjust their financial records to match that?
Yes, exactly. That's where the concept of write-downs comes in.
Yeah.
But we'll dig deeper into those a little bit later.
Go.
For now, let's stick to how companies figure out the cost of their inventory.
Okay, yeah, because when I was looking through the research these sent, I saw there were a few different methods for calculating cost.
Yeah.
FIFO, weighted average, specific identification. Honestly, it all looked a little overwhelming.
Right.
Where do we even start with all that?
Yeah. Well, there are definitely a few options.
Okay.
And each one can give a slightly different picture of a company's financial performance.
Okay.
Let's break them down one by one, starting with FIFO, which stands for first in, first out.
Okay, so first in, first out. So if I think about a bookstore, the books they bought first would be the ones they assume they sell first.
Yeah.
Kind of like how a grocery store puts the oldest milk cartons at the front,
Uh-huh.
so they sell before they expire.
Exactly. With FIFO, companies assume the oldest inventory sells first. This can impact their reported profits, especially during times of inflation.
Inflation, how does that play into it?
Let's imagine a company bought materials a year ago, right?
Okay.
For $10 each. But now, because of inflation, those materials cost $12.
Okay, yeah.
Using FIFO, they'd record their cost of goods sold at the original $10, showing a higher profit margin, at least on paper.
So the way they track their inventory cost can actually influence how profitable they appear. That's a pretty big deal.
It can be, particularly for investors who rely on accurate financial data to make informed decisions.
Right, okay. That's FIFO. What about the weighted average method? Does that one involve a lot of complicated math?
It's actually pretty straightforward.
Okay.
So the weighted average method takes all the inventory a company has on hand and calculates an average cost. So think about a company that sells barrels of oil.
Okay.
It's difficult and unnecessary to track each individual barrel, so they use a weighted average to simplify things.
Okay, that makes sense. So FIFO for distinct items, weighted average for bulk goods. What about specific identification? When would a company use that method?
Specific identification is used for unique high-value items. Think of a car dealership that sells luxury vehicles.
Oh,
Each car has a unique VIN number and a specific purchase price, making it easy to track that individual cost.
oh, so they know the exact cost for each car because they're not all the same. That makes sense.
Yeah,
But why does all of this really matter? Are we just getting lost in the weeds of accounting here?
not at all. These methods, they have real-world implications, especially when it comes to a company's tax obligations.
Wait, you're telling me that choosing one way to calculate inventory cost versus another could actually affect how much a company pays in taxes?
That is exactly what I'm saying. And that's
But,
just one of the many reasons why understanding IAS 2 is so crucial.
okay, I'm officially intrigued. This is already way deeper than I thought it would be.
So let's take a closer look at how these inventory valuation methods we've been talking about
Okay.
tie into a company's tax strategy.
All right, let's do it. You mentioned before that using FIFO can sometimes make a company look more profitable during times of inflation.
Right, exactly. But there's a catch.
Uh-oh.
In some countries, tax authorities, they actually require companies to use the same inventory valuation method for both financial reporting and tax purposes.
Ah, so if a company is using FIFO and showing higher profits on paper,
Yeah,
they might end up with a much bigger tax bill.
exactly. It's this trade-off. They might look good to investors, but they could end up paying more in taxes.
That's so interesting. It's like companies have to play this strategic game,
It is.
weighing the pros and cons of each method.
Absolutely. It's a strategic decision that goes way beyond just the accounting department.
Okay, so we've covered the different ways to calculate inventory cost. But what happens when things don't quite go according to plan? What if the value of a company's inventory just drops?
Yeah.
You mentioned write-downs earlier.
Ah, yes, write-downs. They're an essential part of IAS too.
Right.
And a reality for so many businesses. Let's dig into that a little deeper.
Okay, so let's say a company has like a bunch of inventory
Yeah.
that suddenly isn't worth as much as they initially thought.
Yeah.
What are some of the reasons that could cause this kind of value drop?
Well, one of the most common reasons is obsolescence.
Obsolescence.
Yeah, so think about the fashion industry. Trends change so quickly.
Right,
If a clothing retailer is stuck with a warehouse full of last season's styles, the value of that inventory, it can really plummet.
right. No one wants to buy clothes that are out of fashion, even if they're brand new.
Exactly. Another common reason is damage. Let's say a shipment of electronics
Okay.
gets damaged in transit.
Right,
Those electronics, they might still function,
right.
but they're not going to be sold at the same price as the ones that are pristine, you know?
Makes sense. And I imagine sometimes companies can just misjudge demand
Yeah,
and end up with way more inventory than they can actually sell.
exactly. And that's called overstocking.
Hmm.
It can lead to some pretty big write-downs as companies try to offload all that extra inventory through, discounts,
Right.
liquidation sales.
Right, right. So when a company realizes they need to write down their inventory,
Yeah.
what actually happens? Do they like magically just erase the value from their books?
It's a little more formal than that.
Okay.
What they have to do is adjust their financial statements to reflect the lower value of that inventory.
So that means their reported profits also take a hit?
Unfortunately, yes. It's a double whammy. Inventory's worth less, and the company also shows a reduced profit for that period.
Ouch. No wonder companies try to avoid write-downs as much as possible.
Right.
But sometimes it's unavoidable.
Right. Of course, sometimes market conditions change really unexpectedly or unforeseen events happen.
Right.
But, savvy companies actually use write-downs strategically.
Strategically. What do you mean by that?
Well, let's say a company decides to take a big write-down all at once, to kind of clear the decks.
Okay. Yeah.
That can actually make their financial performance look better in future periods.
Interesting. So it's like hitting the reset button,
Exactly.
repositioning themselves for the future.
It's all part of managing a company's financial health in the long run.
This is really giving me a whole new way of thinking about inventory accounting.
Yeah.
I used to think it was just about, bean counting and crunching numbers, but it's so much more dynamic than that.
It is. It's about strategy,
Yeah.
risk management, adapting to all these ever-changing market conditions.
Okay, so how can companies try to minimize the risk of write-downs in the first place?
Yeah.
It sounds like having a really solid inventory management system is crucial.
It's essential. Companies need to be able to track their inventory levels in real time,
Okay,
forecast demand accurately,
yeah,
and make sure that they're not hanging on to dead stock
Right.
And they also need to be really in tune with market trends,
Yeah,
adjusting their purchasing and production plans as needed.
it sounds like a delicate balancing act to manage all of that.
It is. It really is. It's about finding that sweet spot between having enough inventory to meet demand,
Okay.
but also avoiding the pitfalls of overstocking.
You know, this reminds me of something we touched on a bit earlier. The fact that IAS 2 isn't just about internal accounting, right?
Yep. Right.
It also ensures that companies are transparent with their investors and with the public.
That's a crucial point. IAS 2 helps to create a level playing field by requiring companies to disclose their inventory accounting policies and any big write-downs
Okay.
in their financial statements.
So investors can really see how companies are managing their inventory and make more informed decisions.
Exactly. It's all about transparency and accountability.
This has been incredibly insightful.
Yeah.
I feel like we've really peeled back the layers of inventory accounting,
Yeah.
uncovered this whole world of strategy and decision-making.
And we've only just scratched the surface. There's so much more to explore, but I think we've covered a lot of ground today.
We really have. We've talked about the different types of inventory, the different methods for calculating costs, the complexities of write-downs, and all the strategic implications that go along with all these choices.
It's been a really fascinating deep dive.
It really has. But before we wrap up completely,
Yeah.
I want to shift gears just a little bit and
Wow.
bring all of this back to our listeners. We've been talking about inventory in the context of, big businesses. But I think there are some interesting parallels to our personal lives as well.
I'm intrigued. Tell me more about that.
Well, we all have our own inventory of sorts in our homes.
Right.
Clothes, books, gadgets, you name it.
Yeah.
And just like those big businesses, we sometimes have to make decisions about whether to hold on to things or whether to let them go.
So, are you suggesting that we should all start treating our personal belongings like a financial portfolio?
Maybe not to that extreme.
Okay.
But I do think there's value in being mindful of the resources that we have, both financial and material. Asking ourselves, is this item still serving me? Is it appreciating in value?
Mm-hmm.
Or is it depreciating? Could I be using this space for something else or this money more effectively?
Those are really great questions to ask.
Yeah.
It's about being intentional with our choices.
Right.
And recognizing that even something as simple as our belongings, they have a life cycle.
Yeah.
And they have an impact on our overall well-being.
Yeah. And it makes me think about the concept of opportunity cost.
Mm-hmm.
If my closet's overflowing with clothes that I never wear,
Yeah.
that's not just wasted space. That's wasted potential.
Right.
That money could have been invested elsewhere, or that space could be used for something more meaningful to me.
You're highlighting the importance of recognizing that resources are finite,
Right.
even in our personal lives. Just as a company wouldn't want to tie up all their capital and inventory that's not producing anything, we don't want to clutter our homes and our lives with things that aren't serving us.
Exactly. And just like a company might need to kind of reevaluate its inventory and make some tough decisions about what to let go of, we can also periodically assess our own personal inventory, right?
Yeah.
And see what aligns with our values and our goals at this point in our lives.
It really is. It drives home the point that these principles from IAS 2, they can be applied to so many areas of our lives.
Yeah, it's not just about business.
Not at all.
So the next time our listeners, are feeling overwhelmed by all their stuff or having a tough time making financial decisions, maybe they can think back to IAS 2.
Exactly.
You might be surprised at how much clarity those concepts can give you.
Absolutely. It's all about looking beyond just the numbers and understanding those underlying principles.
Yes.
And that's what we've really tried to do today in this deep dive.
Well said. I think we've come full circle.
I think so too.
We hope our listeners have a newfound appreciation for the world of inventory accounting and how it connects to their own lives.
It's been a pleasure unpacking this topic with you.
Thanks for joining us on this deep dive into IAS 2. We'll be back soon to tackle another fascinating topic. Until then, keep learning, keep exploring, and keep those deep dives going.